Hello everyone, welcome to the Trendline Invest channel. So in this video, I'm going to discuss a complete investing strategy, including the scanner, how to enter, how to exit, how to pick stocks based on fundamental parameters, and finally, when you should buy, how much to buy, and how you can add on to your position and how to manage your risk. It's going to be a complete masterclass on investing using technical analysis. So let's get started first with the scanner. Now, you need to have a scanner in order to pin down on some stocks for investing. Now, the scanner I use is based on CCI, and this is the scanner that I use. Now, I have 4 different scanners here in this dashboard. The link is here, but I focus on this scanner only for investing. So, in case you don't know what CCI is, there's a detailed video on my channel. Do check it out. But we will be focusing on the scanner results from this particular scanner in order to find good fundamental stocks. So, that's the scanner part. Now, when should you run the scanner? You should run the scanner only on weekends. If you have a full-time job, then focus on the scanner on weekends, Friday evening or Saturday or Sunday, and then you can buy the stocks on Monday. If you want to run the scanner during the weekdays, it's absolutely fine. You can run the scanner during the weekdays, end of day, check it, and you can also take an investing bet. But if you do not have the time, I recommend focusing on weekends. You might not need more than a couple of hours once you have mastered this strategy. Okay, so let's move forward. So there are some rules that, as always, I discuss in my channel. So the rules for this strategy is you can invest in any stock in the markets if it satisfies the conditions. So any stock that is listed, if it satisfies the conditions that we discussed, you can take a bet on that. Time frame to focus on is purely weekly charts. Now, if you're an investor, you are looking for multi-bag returns, 2x, 5x, sometimes even 10x. So it's very important for you to focus on weekly charts because there will be upsides and downsides in the daily charts, and that might flutter you, and you might get confused. So focus on weekly charts. This next rule is the weekly trend for the stock should be up, and the price should be changing the trend on weekly charts after a minimum 1 year sideways or downtrend. I will discuss this in detail, but if it consolidates or if it is in a downtrend for more than 1 year, it's even better, right? So the larger the consolidation, the larger the correction, and if it comes out of a downtrend after a very long time, few years, then it's even better, right? We'll use the pivot high low to identify this, but just keep this in mind. Next, CCI on weekly should be crossing 100. Now that's a scanner, so that's not really a criteria. Ideally, you will get stocks where CCI on weekly is crossing 100. The next point is relative strength should be greater than its 52-week moving average. I'll discuss this also in detail, but remember, this is the most important thing for you to know in the entire strategy. This is the one condition that has to satisfy after you get a result from the CCI scanner. Now, the strategy is going to be very simple. Entry is going to be on the first higher high on weekly charts. The stop loss will be on the pivot weekly low. I will discuss everything in detail. I'm just summarizing the conditions here. Then you buy at first higher high, and then you add more after minimum 5 weeks of consolidation. The maximum you'll allocate to a stock in this strategy is 10% of your portfolio. So if you have 1 lakh, maximum you'll allocate is 10,000, not more than that. So if you have 10 lakhs, the maximum you'll allocate for a stock is 1 lakh. So if you're a beginner, I suggest going for 5%. So if you have 10 lakhs, you will not invest more than 50,000. Okay. The maximum number of stocks in portfolio should not be more than 20, and the total risk in a single position will be 2% of your portfolio, the maximum total risk. This is not just total, the maximum risk that you will take is 2%. So if your portfolio size is 1 lakh, you will risk 2,000. If your portfolio size is 10 lakhs, you will risk maximum 20,000 on a stock. Okay, but we will not discuss risk so much. It's just a guideline for you. Now, what are the fundamental parameters? Now, the most important thing for me from a fundamental perspective is ROC should be above 10% at least, right? So if you are looking for investing, you need to look at companies which are good. Now, remember, in markets, the price is a slave of earnings. A price is a slave of profits. So if the company does not generate profits, then the price appreciation will last probably very short time, and then it will finally start falling down. So if you are looking for long-term growth, long-term returns, then you need to look at companies which are having a good ROC. Anything above 10% is good, but if you find anything above 25%, it's excellent. 20% and above is excellent, and you must probably have that in your portfolio, especially if the stock has not done well. The next is, it's a simple thumb rule or a guideline that I follow. Ratio of PE to ROC should be around 2. For example, if the ROC is 10% and the PE is 50, then this ratio comes to 5, right? So dividing PE by the ROC, which is 5. Now, if the ratio is more than 2, 2.5 is okay, but if it's above that, then you need to ignore such stocks. Now this is very important, because if you're going to buy a ratio which is very high, like 5 times, then you're looking at a PE of 50 where the ROC is just 10%. So you're buying a company which is already overvalued, right? Now this is just a simple thumb rule to eliminate such stocks. Now there can be cases where it might be a good stock, so it's okay to miss a few stocks. There are thousands of stocks in the market. It's okay to miss a few and just be satisfied with it, right? The debt to equity ratio should be below 1, which means we're looking at companies which do not have a huge debt, right? Now this is very, very important. The next condition is you have to check for stocks which have consistent increase in sales and profits. Now I covered a lot of stocks on the Sunday video, so in case you want to check some examples, check them out. A lot of stocks that we covered on Sunday has very good sales, profits, and sales and profit growth. Now, a huge fluctuation is not good and can be avoided. So if you see sales going up from 100 crores to 50 crores, then again 150 crores, and again going back to 100 crores, that's not the kind of companies that we're looking at. We're looking at companies which can grow sales from 100 to 120 to 140, 150, 160, like that, right? It has to be steady, but steadily going up and not down. Now, some exceptions, like 1 year exceptions, like COVID exceptions, are totally fine. You can ignore if there's a dip during COVID times, these kind of situations. Otherwise, the company's sales needs to be steady and profit needs to be steady. Now, these are just guidelines for people who do not have time to analyze and go into in-depth fundamental analysis research. So there might be some exceptions here and there. So completely ignore that. And if you do not have time, this is a simple set of guidelines for you to follow in order to pick good fundamental stocks. Okay, so let's move on with some examples. Now, Lincoln Pharma for me here is a good company because ROC is good, P is good, also a small company. But one thing that you should notice is I don't have the sales numbers here. Also, sales and profit growth were decent, right? Then you have Gillette India here. ROC is 51, P is 56. Now here, if you just look at P as a number, you might find it overvalued, right? And that's why I give you a simple formula. If you divide P by ROC, and if it's anything less than 2, 2.5, it's totally fine. So this is a good company. Whereas a company like Suzlon has a ROC of 20 and P of 76. Also, the debt to equity is 1.76. So this company is a complete avoid for me, right? Whereas here, if you see debt to equity is 0, 0, which means the company hardly has any debt. And again, another example is Jayaprakash Associates. Again, the PE is literally 0, which means this company does not even post profits. So straight away reject, right? Debt to equity is very high, so straight away reject, and don't look at these two stocks. Such stocks should be ignored for your investment portfolio. So let's move on. Let's set up TradingView first. I'm going to show you how to set up TradingView using which indicators, and then we'll come back and discuss the entire strategy itself. So tools required are CCI, relative strength, and pivots with 10-10-10 setting. And this is the only thing that you require in order to start investing with technical analysis. So let's look at the TradingView setup now. Okay, so I have the TradingView in front of me, and I'm going to add 3 indicators. The first is going to be the pivot points high-low. Right, you click on this and then you will see the pivot points plotted here. So here you have to go and keep it to the default 10-10-10-10, and always we are going to look at weekly charts, right? So this shows that the pivot points have been plotted. So that's the first indicator that you need. The second indicator you need is commodity channel index. So here, if you click on this, you will find commodity channel index. I'm just going to close this so that you know what settings you need to set up. So here, if you go, you can click on settings here and then change this to 34 over here. So once you change this to 34, it shows you the CCI indicator for the last 34 weeks. Now, I've done a separate video on CCI and also done a separate video on pivot high-low. You just need to go to my channel, search for copy my trading setup, and that's the video where I explain all of this there. Okay, so you have the CCI here, and finally you need relative strength. So you can just search for Mansfield RS by stage analysis, right? So you go here and you search for this one, relative strength Mansfield RS, which currently has 803 likes. So you click on this and then you will see it plotting here. Now here you need to go to settings again and change SPX to CNX 500. Plot this and then keep it to default 52, right? We are looking at 1 year data here, 52 weeks data, right? Now this is the settings that you need, and a simple rule is if the stock has CCI above 100, it will come on your scanner. Then if this relative strength here, basically the green line is above this line over here, then the black line is above the blue line over here, then the stock is bullish. And if the price closes above the previous pivot point, then the stock is entering uptrend, right? Now I've done a detailed video on this. You can go and check it in my YouTube channel. I've explained everything there. But now let's move on to the strategy. Okay, so now that we've seen the TradingView setup, now let's get started with the strategy itself. Now the first thing is the stock, once it comes in a scanner, you need to open up TradingView and you need to analyze the chart. Now here I've taken the example of Alchem Lab to explain the entire strategy. The first thing you have to do is switch to weekly charts. CCI, when it's greater than 100, will come on your scanner. So then you open the chart here, right? You open the chart in TradingView and then you check. The first thing you need to check is if the relative strength is above the green line over here, right? Now you need to check relative strength. This black line is the relative strength and the green line is the 52-week moving average of the relative strength. Now this tells you whether the stock is outperforming the markets. So basically, if the stock is giving you higher returns than CNX 500 or the overall Nifty 50 that we're looking at, right? So if the stock is giving you much higher returns than the benchmark or the index, then this black line will be above the green line. It's that simple. If it is below, which means it is not giving you greater returns than CNX 500, right? Now here, that's the first thing to note, relative strength. The second thing to note is the pivot point. Now, when a stock is in a downtrend, the pivot points here will keep going lower and lower. Now, if you see here, it was 2469, 2268, 1992 and 1987. So it kept going lower, which means the stock is in a downtrend. Now, if you understand support and resistances, you do not have to use it. But if you are a beginner, then this is a good way or a very objective way to find out trends. And now when the stock crosses for the first time here, that's when it comes in a scanner. And then you need to observe the previous pivot high over here. The previous pivot high is 1987.2, which means when the stock price closes above this pivot point for the week, which is exactly happened, I'll show you in the next one. When it closes above that pivot point over here, that means the stock is entering an uptrend. So when it comes in a scanner, note the previous pivot point and set an alert in TradingView, right? If you don't know how to do it, just Google some YouTube videos, you will get some YouTube videos, or add alert in Zerodha. It's that simple. And then you will buy once the price closes above this pivot point. Let's move on to that part here. So finally, we had the price closing above the pivot high, 1987.2 in this week over here, right? So that's when you will buy your first position. Now you need to wait until Friday to observe if the price closes above that pivot point. So if you see the previous weeks, it never closed above that pivot point. And for the first time, it closes here above the pivot point, right? So you buy the stock on this day, Friday or a Monday opening. You buy the stock on that day of the week and you allocate some money. I'll come to that shortly, allocation strategies. But one thing you need to note is the stop loss is going to be here. Your first stop loss is always going to be at the pivot low point over here. Now, you might question why the stop loss is so deep. I'll answer that shortly. But the first thing you need to do is your investing portfolio and your trading portfolio need to be separate. You need to either handle separate sheets or you need to have separate accounts so that you don't mix your investing and trading. Because investing, stocks will keep going up like this, coming down like this, which means it will create a lot of frustration, especially when the stock is going like this and has not given returns for 2 years, right? Now, these are the times you have to completely avoid touching your investing portfolio, right? Unless your stop loss hits, do not exit. So both require different strategies, your different position sizing techniques and different mindset. So that's why you need to keep them completely separate and do not try avoid opening your investing portfolio during the weekdays and try to open it only during the weekends. Try to keep that also a little bit, have some discipline, and you might do that also. You might get accustomed to that, right? And we want huge multi-baggers. So here, if you're investing somewhere in 100, you want at least 200% returns or 100% returns. So which means the stock will not directly go up 100% or 200%. It will go up, it will come down, it will go up, it will come down. So you need to be able to handle that fluctuation. And sometimes the stock might drop 30%, 40%, or even 50%. So you need to be having the mindset to go through such losses. And if you want to go through such losses, such profits, you need to have such big stop loss, right? I'll also teach you how to reduce the stop loss, but that's coming soon. But there will be wild swings between your pivot highs and lows. So this is a pivot high here, and this is a pivot low. So you see the stock went from 1856 to 1455. You need to have the mindset to go through this drawdowns, right? You need to accept that in your investing portfolio. Okay, so let's move on to the next slide. Can the stop loss be on a daily swing low? Now, I told you some reasons, but you can keep the stop loss on the daily swing low, but you need to understand the consequences. The first point is the likelihood of stop loss hitting swing low on daily charts is very high, whereas the stop loss hitting on a weekly chart swing low is very low, right? The reason is because on the weekly charts, your stop loss is very far away, right? Whereas on the daily charts, if you're swing trading or positional trading, your stop loss is very near and it will most likely hit. Now remember, these points here are major demand points, right? So when the price comes here, you see it rises up again. So it goes up, it comes down, rises up, comes up, rises up, right? So these points are major pivot points. So likelihood of a stock hitting that stop loss after entering an uptrend is very low. Okay, so that's something you have to remember. Second thing is you can still buy for investing with stop loss at swing low on daily charts, but only if you're good at understanding price action. Now, unless you really understand how price and markets work, I would not keep my stop loss on daily charts. Now, that's very important. And if you're a beginner in technical analysis, then it's going to take time to understand price action, and you need at least 1 to 2 years. So do not do stunts and switch to daily charts after taking a decision for investing. Do not do that. So as I said, in weekly charts, the chances of stop loss hitting is very low. And even in a sluggish market, there is a high probability that the stock will go sideways after a trend change has occurred. Right now, you might have noticed in the last 1 year, there have been stocks which have done very well in spite of the market being down. Now, that's primarily because of the outperformance of these stocks. And there can be stocks which, after entering an uptrend, if the market goes sluggish, these stocks will continue to do well. Okay, and you don't have to check charts daily, and just on weekend is fine. The only problem is, as I said already, some stocks will go down 30-40% in a bear market, which is totally fine, but sometimes the stop loss might not be hit. Now, in this case here, if you move forward, you'll also see we had such crazy moves in COVID times. So that's something that you will have to accept in investing. Okay, it's simple. Now, how much to buy? Now, once you identified the point here to buy, you need to take an entry, right? Now, the closing of this week here was 2000. So your first entry is at 2000. Your stop loss is going to be at 1600. Now, the swing low here is 1660, but I have rounded off this to 1600 because there can be sometimes whipsaws around the major support zones. So I have rounded this off to 1600. You can keep 2% below this stop loss. It should be totally fine. Right now, here I kept it 1600, which is around 20% of our entry price. So the entire stop loss for the first portion is 20%. And you are going to risk 1% of your entire portfolio, right? Which means if you have capital of 1 lakh, you will risk around 1000 rupees. It's not 100, it's going to be 1000 rupees, right? So if your portion size, if you're going to risk 1000 rupees and if your stop loss is 400, then you just divide your risk amount by your stop loss, and that is going to give you 2.5 shares or 3 shares, right? You can always round up and buy 3 shares. So total value here is around 6,000 rupees is what you're going to buy, which is 6% of capital. So you're investing in Alchem Lab, you will allocate 6% if you bought the stock at this point over here, right? Now that's the first entry. Now moving ahead, what will be your second entry? So once you buy your first entry over here, your stop loss is here, right? And then you will not buy your next position until the stock has consolidated for a minimum 5 weeks, right? What do I mean by consolidation? After making a high, the stock should not cross that high at least for 5 weeks, right? Now, for example, after this week, the stock almost went sideways for almost 2 years, right? Now here, after we bought here at this point, the stock went up, up and up. And then for the next 5 weeks, the stock did not cross that high. Now in this case here, in fact, it was 1, 2, 3, 4, 5, 6 weeks, the stock did not cross the previous high. Now, whenever stock does not cross the previous high for minimum 5 weeks, that's when you need to make a note of the previous high point, right? Make a note and set an alert on Zerodha or TradingView. And once the price crosses that point, and for that weekend, when Friday it closes above that point, that's when you buy your next position. So this should be very clear. You will not add your next position until there's a minimum 5 weeks consolidation. So if you want to play aggressive, then you can add, like this here. Now, one point is, if you're just a beginner, then I will not add a second entry position because it will be a bigger position size, 10%. So I said in the beginning when I started, I said, if you're a beginner, keep your position to 5%, which means maximum you'll have 20 stocks, right? So you will add here and then you will not add more. But if you're experienced and if you're aggressive, then you can add after minimum 5 weeks of consolidation. Okay, that's the rule. And then you have to trail your stop loss. So once you add here after this week, now your risk has increased, right? So previously your risk was here and now you have a new position, you cannot keep your stop loss here again, right? Because the risk becomes more. So what I would suggest is trade your stop loss to the swing low after this 5 weeks minimum consolidation, and it closes above that point. Trail your stop loss to this point here, right? Now here, by being aggressive, by taking the second position, you are buying more of your quantity plan. Okay, now how does the position size work after the second entry? Your second entry was a 2260. So we bought here on the end of the week here or beginning of next week. 2260 was the closing point, and then your stop loss is going to be 1900, which is this low over here, the lowest point around this zone, right? You can consider the lowest point between this swing low and this point here, which is around this point, which is around 1900 or 360 points or 16%, right? So now you want to calculate how much you can buy. Now the first rule is you risk 1% of your portfolio risk. Now remember, the previous position size also is 1% risk. Now again, you're taking 1% risk here. So maximum 2% risk is what you'll take, or the remaining 4,000. Now remember, the previous position, we took a 6% position of the entire capital, which means you're left with 4%. Now your maximum position size can be 10%, right? So which means you're left over with 4%. So either the position size should be whatever position size you get based on the 1% of portfolio risk, or the remaining 4,000, whichever is less, right? Now this is very important. So now let's assume you want to calculate what is the 1% portfolio risk here, right? Now if you calculate the quantity, what is the amount? Now here, let's assume again 1 lakh capital, risk is 1000. Now you divide 1000 by your stop loss units, 360, and you get 3 shares. Now if you calculate 3 shares into 2260, you will get 6.7% of capital, which means you have a total of 12.7%, right? 6.7% here, and here we have 6%, right? Which is also here. So if you add 6 plus 6.7, it brings to 12.7. Now it's okay, you can go ahead and buy 12.7 if you're aggressive, but if you're a beginner or if you do not want to be aggressive, I would only invest the remaining 4,000, right? So 6%, 10% is a maximum. So 10% minus 6% is 4%, which means you will invest only 4,000, right? So if you have to invest 4,000, all you have to do is calculate the number of shares, which brings us to 4,000 divided by 2260, which is 2 shares, right? So total value would be 4520. So your total quantity in the first position and in the second position is going to be 3 plus 2, 3 shares here and 2 shares here, which brings us to 5 shares. So your total position size would be 10,520, or 10.5% of your overall capital, and your average price would be 10,520 divided by total shares is 5, so your average price is 2104. So that's your entire position. So your risk on the first position, so the risk that we took here is 1%, but that risk will reduce because your stop loss has gone up from 1600 to 900, right? So your position risk on the first position with new stop loss will be, your entry price is 2000 and 1900 is a new stop loss, which means you have a loss of 100 points only. So entry price is 2000 and new stop loss is 1900, which means you are risking only 100 rupees for 3 shares, which is 0.3% of capital. So by raising your stop loss from 1600 to 1900, your capital on the risk on the first position size has come to 0.3% of your capital, right? Which has come down almost by 0.7%. So the total risk on Alchem Labs is going to be 300 from your first position and 720 from the second position. So second position, the risk is 360 into 2 shares we bought, so which is 720. So overall risk on the entire position is 1.02%, right? I hope this is clear. You have to rewind this again and again and watch. This is the most important point in trading and investing. So let's say if the price closes at 1500 by chance. So because we have a weekly closing basis stop loss, the stop loss for this investing strategy will be weekly closing basis. Now that's why I said you have to, if you're a beginner, keep it to 5% and don't take 10% like I've taken here, right? Do not take the second position if you're a beginner. So if by chance by weekly closing basis, let's say we have another COVID crash kind of event and the stock closes at 1500, or stop loss was 1900, and if the stock price closes at 1500, then you will lose 3.2% of your capital. So on the first position, your stop loss is at, you bought at 2000, your stop loss is 1500, so you lose 500 by 3 shares. And your second position, your stop loss entry is 2260, your stop loss is 1500, so you lose almost 760 into 2 shares, which brings us to 3020 or 3.02% of your overall capital. That's how much you lose. So on a 1 lakh capital, right, you will lose maximum 3,000 rupees, right? That's how much you lose even in the worst case scenario. So that's the entire position sizing. Now, how do you trail your stop loss? Now, as I said before, you should always trail your stop loss after first time here, then after the second entry here, and then you're going to trail based on the weekly swing low over here, right? So trail your stop loss to weekly pivot low over here, to pivot low over here, to pivot low over here. So whenever the pivot low is printed, your trailing stop loss will be there, right? And then you will exit here when the price finally closes below the previous pivot low. So the pivot low kept going higher, 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 and finally we had a close below that, and that's when you exit. Okay. So how would have this position done? So average price was 2104. We bought 5 shares for 10,050 rupees, 10,520 rupees. So total value as on exit date. So we exited here. Total value was, the share price was 3175. That weekend close was 3175. So we made a total value of 15,875. So total profit is 15,875 minus 10,520, which brings us to 5,248, which is a net return of 5.248% of your overall capital, which brings us to a risk reward of 5.14. So we took a risk of 1,020. Our maximum risk entire position was 1,020. Remember here, this was a maximum position. So we took 1% before, which was 1,000 here, and here when we added new position, our total risk was 1,020. So on 1,020, we gained a profit of 5,248, which is 5.14, which is a very good return in terms of risk reward position. Now you need a few of these in the next 2-3 years, and you will make decent portfolio returns on your entire portfolio, right? Now that's how the strategy works. Now here is a beautiful example setting up right now as we discuss, which is Nesco, right? It is I discussed this in Sunday video and it looks really good. It has all the characteristics of a bullish stock. CCI crossed 100 for the first time here. Little strength was bullish, so you could have taken the first position here because the price closed above this pivot point here this week, right? And then you take now a second position because after this high, the stock did not cross that for minimum 5 weeks. Almost after 1 year, 6 months, the stock is again breaking out, 9 months, right? So you add your second position over here after 45 weeks of consolidation. Now that's how you invest in stocks. Now, if you did enjoy this video, don't forget to buy me a coffee. The link is in the description. You can support me, support my Twitter handle and YouTube handle by buying me a coffee. And if you're new to my channel, don't forget to subscribe to this channel and like my video. And do me a favor by sharing this video with a lot of your friends, family and colleagues who are struggling to understand investing, and let them know that investing using technical analysis is very simple. Okay, that's it for today. I'm going to leave you here. I'll see you in another video. Until then, take care, stay safe and trade safe. Bye-bye.